My name is Nasser Sheikh and I'm a Chartered Certified Accountant with Hoffman & Cohen, a firm based in Knightsbridge, London. Today's topic of discussion is direct loan, which applies to the majority of small businesses in the United Kingdom. Most of you may already know what the direct loan is, but many of you may be thinking about taking the plunge and starting your own business. So let's have a quick explanation on what direct loan really is. As you may be aware, the limited company is a separate legal entity from its owners and directors. Usually, at least one of the owner is the director of the same limited company. So if you loan an amount to the company, then the company owes you that amount. Similarly, if you take the money out from the company, which is not your salary or dividends, then you owe this money to the company. These are called direct loans. Now, let's say if the company owe you the money, then you're free to charge the interest of the company on commercial terms. But this is a topic that we'll cover on a separate video. Our today's discussion will focus on when you owe the money to the company, which is also known as overdrawn direct loan account. You may ask as that it's your company and the funds in the company are yours to take. So why would that be a loan? This is a general misconception that we encounter, which is the reason why we have created this video. We agree that it is your company and you have the control on the funds accumulated in the company bank account. However, as earlier suggested, that your company is a separate legal entity and therefore money in the company business account does not technically belong to you. I'll explain this further, if you're confused. There's money in the business, let's say, and bank account out of which you take your salary out of the company. Let's say your salary goes through the payroll and then you pay any tax and national insurance via PAYE. If you take any dividends out of the company, then you pay any tax on those dividends through your self-assessment. But however, if you take the direct loan, then it's not your income. No tax is payable. You pay tax on salary, you pay tax on dividends, but direct loan has no income. Now you may be wondering as to why take any other income when you can just take direct loan and pay no tax. Smart, aren't we? Well, not so fast. Well, HMRC understands that loans from the company is not an income and therefore no tax is payable. But they're also aware that this is an avenue which would be open to be abused by the owner-managed businesses who can simply take the funds out of the company and class them as direct loan and pay no taxes. This is precisely why safeguards are in place to stop the owner-managed businesses to abuse their powers or to be an undue advantage on people who are not in the business, who are employees and who does not have these options. The tax law stipulates that if 9 months and 1 day after the year end, the director owes funds to the company, then the company will pay tax at 32.5% till that loan is repaid. Confused, right? Let's use an example. They are your best friends anyway. Say your company year end, it runs from 1st of January 19 till 31st of December 19. On 31st of December 19, you owe 8,000 to the company, which remains outstanding after 9 months and 1 day on 1st of October 20. The company will have to pay £2,600 tax to HMRC, which will be refunded once you have repaid that £8,000 to the company. Brilliant. So why don't we repay the company £8,000 on 30th of September 20 and then take the money out again on 2nd of October 20. This way we still not owe the £8,000 to the company on 1st of October and do not pay £2,600 to HMRC. You're certainly smart, I've just said that, but contrary to your belief, HMRC is from the same world we live in and certainly thought of ways to dash your hopes by giving it a creative term of bed and breakfasting. What the rule stipulates is that if you repaid 8,000 to the company to avoid for your company having to pay the £2,600 and redo the further £8,000 within 30 days, then the £2,600 tax will remain payable. You see, HMRC is working hard to make the time worth the salaries paid by the taxpayers. There are of course a number of legitimate ways to avoid falling into the trap of tax payable on overdrawn direct loan accounts, and it is therefore prudent that you discuss a tax efficient strategy of withdrawing the funds from your company, as the last thing you would want is for HMRC to come knocking at your door asking for the tax that you would not have provision for. This is where we'll conclude this video and allow you to go online and repay the loan you thought was in your hands tax-free. I'll be happy to answer your questions that you may have. You can email me your queries to info@tnfinance.com, and I'll be creating a video for every 10 questions I receive. So I wish you a great day and good luck.